Hello there, it's Chris Hobart, the Wealthologist, and I wanted to welcome you back to another episode of the Wealthologist Weekly, where we help you make sense of the financial world and turn smart strategies into smart wealth. Now, today, I want to talk about something that's been in the headlines a lot, decreasing interest rates. But more importantly, what a lot of people are asking is, how can I cash in on this opportunity of decreasing interest rates? It doesn't always seem that way when rates go down that there is opportunity, but there is. You see, when interest rates fall, it doesn't just mean that you can score a lower rate on a new car or a home. It actually begins to open up a world of financial opportunities for homeowners, investors, and business owners. So you can take advantage of this low interest rate environment in a lot of different ways. Let's dive into some key strategies. Now, first, I want to talk a little bit about mortgages and refinancing. Now, I know many of you have mortgages from years and years and years ago that are still low. Might not be the thing for you to think about. But for others, with rates dropping, you have an opportunity to reduce monthly payments if you bought a house in the past couple years when interest rates were higher, or you may be able to shorten your loan term. For homeowners, this could really mean serious savings. Geez, just imagine dropping your interest rates by just 1% on a $500,000 mortgage. Over time, that's thousands of dollars saved. But it's not just about lowering your payments. You could also shorten your loan from a 30-year to a 15-year, and you could be mortgage-free even faster. Now, maybe you've built up equity. There's the ability to cash out some of your profit or your equity inside of there. You can refinance, take out some cash, and use it for home improvements or pay off higher interest debts, or even invest in something new. Maybe you've got an adjustable rate mortgage, and it's going to adjust, or it adjusted during those higher interest rate times. Now might be a good time to start looking at switching to fixed rates, or when rates drop even further to do so, which will help you lock in peace of mind for the future. Now, second thing I want to talk about, bond investing, which is how do we really maximize our yield in a low rate world? So when interest rates drop, bond prices usually go up, which makes bonds a pretty attractive option for investors. Now, if you're holding on to some bonds, you might see their value increase on your statements. And if you're looking for new investments, you might want to consider some longer term bonds, which allows you to lock in those yields before rates fall even further. Now, municipal bonds are also a smart play for some folks because they come with tax benefits, which is a double win in this low rate world because you get some steady income coming in and you get to pay fewer taxes. And who doesn't love paying fewer taxes? Now, if individual bonds are overwhelming because there's a process to buying them and everything, you can opt for either a bond mutual fund or ETFs, exchange traded funds. They help spread out the risk and let you ride the bond market a little bit differently. Those waves have maybe a little bit more cushion. Now, third thing I want to touch on. Money markets versus bonds. What is the right move? What should you be considering? Well, a lot of people wonder if they should stick with safe money markets or shift to bonds when rates are low. And the thing is, money market accounts are great for more safety and liquidity, especially if you need quick access to your cash. But in a low rate environment, the returns are going to reflect that low rate, so they're going to go down as well. They might not even keep pace with inflation, so just keep that in your head. Now, bonds, on the other hand, offer a higher yield potential. Potentially, with a longer-term bond, you could secure better returns before rates dip further. But I want you to remember, more yield can mean more risk, specifically if it's a riskier bond. So balance your portfolio to protect your assets while still growing your wealth. Now, something else to consider, number 4, is refinancing other loans. So obviously, we've got our mortgages and things like that, but there's other things that benefit from lower rates as well. You can refinance student loans or car loans, especially if you got variable rates or you took higher interest rate debt when rates were higher. Let's talk about private student loans. Those could be worth refinancing right now, but if you've got federal loans, there might be a little bit more caution, specifically with loan forgiveness that has been going on. Now, what about auto loans? Well, same deal. You could lower your payments or pay off your car faster by locking in a lower rate. Now, some people have asked us about number 5, which is real estate investing. And this goes beyond refinancing. You see, interest rates affect more than just your current mortgage. They actually open up doors for new real estate investments. Now, you might be thinking about expanding your real estate portfolio. Well, lower mortgage rates improve cash flow and make those investments even more lucrative. And lower rates mean lower cost, which, hey, that typically translates into higher potential profits. Something else to consider here is home equity lines of credit, or HELOCs. They can be more attractive when rates drop as well, because as those rates drop, so do your payments, which gives you extra funds for home improvements, debt consolidation, or other investments. Finally, number 6 is business loans, which is how do you take these low interest rates to fuel growth with lower borrowing costs? As a business owner, when we see declining rates, that's a signal to explore new loans or refinancing existing debt. Cheaper loans often mean better cash flow and potentially greater expansion opportunities. So if you're thinking about funding a big project or investing in new equipment, now could be the time to pull the trigger. Again, could rates go a little bit lower? They can, but as rates have dropped, it is compelling to look at. Now, to wrap things up, declining interest rates, well, they open up a world of opportunities, whether you're looking to refinance, to invest, or expand your business. But remember, rates are cyclical. So it's important to strike while the iron is hot and make strategic moves now that align with your long-term goals. Maybe you're thinking about refinancing, or you're thinking about your investment strategies, or anything else we covered today. Don't hesitate to reach out. Our team's here to help you make the most of this low-rate environment. And hey, if you found this video helpful, make sure that you like, subscribe, share it, hit a notification bell somewhere so you don't miss our next episode of the Wealthologist Weekly. As always, thanks for watching, and I'll see you next time.